Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner, and you can find me on the web at elevationfinancial.com. Today I'm going to talk about the cash balance plan. This is for business owners out there, mainly for solo business owners. The cash balance plan is a really powerful savings tool, tax savings tool specifically for solo business owners. So we're going to talk about how you can save a ton on taxes with a cash balance plan as a solo business owner. Again, as a solo business owner, you're probably looking for ways to maximize tax savings while at the same time securing your financial future. Every business owner I know hates paying taxes. Luckily, there is a pretty powerful retirement savings tool that lets you achieve both goals, and that is called the Cash Balance Plan. So it's a pretty unique retirement savings vehicle, and it combines the high contribution limits of a traditional defined benefit plan with the flexibility and the portability of a 401k, which makes it a really attractive option for self employed individuals and small business owners. So, at its core, a cash balance plan is a type of pension plan, and it allows you to set aside a significant portion of your income on a tax deferred basis. Unlike other retirement plans like SEP IRAs or solo 401ks, cash balance plans offer you much higher contribution limits depending on your age and your income. So, this means you could potentially save more for retirement while also reducing your current tax liability. Setting up a cash balance plan does take some upfront planning and probably going to need some professional assistance, but we'll talk more about that in just a few minutes. It's not too burdensome to get that done. So, let's take a look at the advantages and the tax benefits of a cash balance plan. So, one of the most significant advantages of the cash balance plan is its high contribution limits. So, compared with other popular retirement plans like SEP IRAs or solo 401ks, cash balance plans allow for much larger annual contributions. So, depending on your age or income, you might be able to contribute well over $100,000 per year to your cash balance plan. So, most business owners I see that have these plans set up, they can contribute over six figures a year into the plan. So, that's really beneficial for high earning solo business owners because they can maximize their retirement savings while minimizing current tax liability. So, because that is a tax deferred investment, the contributions you make to the plan are on a pre tax basis, which means they reduce your taxable income for the year. Additionally, the investment earnings in the cash balance plan they grow tax deferred, so you won't pay taxes on those gains until you withdraw the funds in retirement. So the tax deferred growth can really boost your retirement savings over time because the money compounds without being subject to taxes on capital gains or dividends along the way. So the combination of high contribution limits and tax deferred growth make the cash balance plan a really powerful tax savings tool. So again, you're contributing a large portion of your income to your plan each year, which significantly reduces your taxable income and therefore your tax bill. So that's really advantageous for solo business owners in high tax brackets because the tax savings can be very substantial. So also, if you withdraw funds in retirement, you may be in a lower tax bracket, which means you might pay less on taxes on those distributions. So you got to kind of look at the tax brackets now versus later, but often that's the case. So to be eligible for a cash balance plan, you need to be self-employed or own a business, and that really makes it an ideal option for solo business owners across pretty much any industry. A lot of times they're medical professionals, attorneys, consultants, freelancers, anyone who's a high earning solo business owner. So again, these high earning solo business owners generally benefit the most from the cash balance plan because they can make larger contributions and realize those greater tax savings. They can even get you in lower tax brackets. So that being the case, I mean, even solo business owners with more moderate income can still take advantage of the benefits if they want to just put a lot into savings and dramatically lower their tax bill. That can still be a benefit. So it's important to note that cash balance plans do require consistent funding because you'll need to make substantial contributions each year to maintain the plan. That's part of the rules of the plan. So that can be a significant financial commitment. But for many solo business owners, the tax savings and long term retirement benefits are really worth it. So, cash balance plans do offer some flexibility in contribution levels, depending on, again, income, age, etc. So you can adjust based on business profitability and cash flow from year to year as well. But in general, you do need to make consistent contributions. There are some strict rules set up around the plan. So how do you set up a cash balance plan for a solo business? So setting up a cash balance plan has a few steps. One is to make sure you work with an actuary who specializes in calculations for cash balance plans. The actuary typically is going to work at a firm called a third party administrator or TPA. They may be the TPA, but often there's a TPA firm that has actuaries on staff. So, third party administrator or TPA for short is typically the type of firm you're going to work for to kind of maintain the plan and do the compliance work around it. So the DPA will help you determine the optimal contribution levels based on age, income, and retirement objectives. They'll assist in designing the plan document, which outlines the specific terms and provisions of your cash balance plan, which includes formulas for calculating the benefits and the interest crediting rate. And so, with the plan design and administration ready to go, you'll need to decide on the investment strategy. And here's the thing: the money held in cash balance plans can be held at most investment custodians. The account type is usually called a retirement trust account, although sometimes it could be called something different depending on the custodian. But for the most part, I've seen it called a retirement trust account type. And so you'd open a retirement trust account at the custodian of your choice, and the TPA would then provide the plan documents and the general oversight of the calculations for contributions. So, because you can hold the funds, at pretty much any custodian, you can generally invest in anything you want, like mutual funds, ETFs, individual stocks and bonds. However, that said, in general, cash balance plans target a pretty conservative rate of return, typically 4 to 5% on average. And that means your investment portfolio is generally going to be pretty conservative. So, because of the conservative return targeted by cash balance plans, it's often useful to think of these plans as more of a tax shelter than an investment. So, later on, it can become an investment because the good news is that you can close the cash balance plan after a certain amount of time. You can roll the balance into another retirement plan like an IRA, and there it can be invested more aggressively if that's appropriate. So, again, it's not that it's not an investment, but it's more so a tax shelter, at least in the beginning. But again, later, once you close the plan, you can then roll those funds to an IRA and invest it any way you want to, more or more aggressively if you want to. So again, you want to make sure that you fund the cash balance plan consistently. It does require consistent contributions to maintain the plan's integrity, and those are determined by the actuary based on plan design and circumstances. So you've got to be prepared to make those annual contributions. And if you don't make those contributions, that can result in penalties and can jeopardize the plan's qualified status. So you want to make sure you're prepared for that. So, more good news: a cash balance plan can also be active in tandem with a solo 401k, which gives you even more flexibility for retirement funding and tax savings. You can have both. You can have a cash balance plan and a solo 401k, which gives you a lot more room and flexibility to save. That the TPA that you work with for the cash balance plan, in theory, should also provide calculations and contribution numbers for the solo 401k as well. So we often call that a combo plan. So let's talk about a few misconceptions about cash balance plans. One misconception is they're too complex for small business owners to really effectively maintain. Okay, so they do have more moving parts and they are more complex, but when you work with a professional to kind of maintain the complex parts of it, it's definitely very accessible. Typically, you work with a financial advisor and a TPA to get these set up, and it can run pretty smoothly with the right help. Another misconception is they can be too expensive. There are costs for setting up and maintaining the cash balance plan. Typically, they can be a few $1,000s a year, sometimes a little more, but typically those costs are outweighed by the potential tax savings alone, as well as the retirement savings benefits. So, most business owners are going to find that the cost of maintaining the cash balance plan are really manageable when viewed as a percentage of the total contributions and tax savings alone. So, pros generally outweigh the cons. A few things to note also. The biggest one of the biggest drawbacks is, again, we've talked about this before, consistent substantial funding. So you do want to make sure that you're prepared to make consistent, substantial funding, but your plan design can allow for some flexibility. So don't be too scared off by that. Work with your plan design provider and you can kind of talk through the options. So another potential drawback is, again, the need for ongoing professional assistance and administration, but that just kind of comes with the territory. You work with a professional TPA, a financial advisor, they'll kind of make sure everything's on track and working appropriately. So hiring professionals to help with this stuff can really make it a lot smoother. So ultimately, a cash balance plan might not be right for everyone, but for a lot of solo high earning business owners, it can be a great tax savings tool. Saves you a lot in taxes up front, gives you tax deferred growth, and sets you up for an even larger retirement account balance in the future. So, again, if you're working with professionals, if you have the right help to get things set up properly, if you're staying in compliance with assistance of those professionals, a cash balance plan is an awesome tool for, again, a high earning solo business owner. Great tax savings, great tax benefits, as well as long term retirement funding. So be sure you work with a trusted professional to get the help you need, and look into it if you want to have a great tax savings tool for yourself as a high earning business owner. So, big fan of cash balance plans. If you have questions about these or anything else, you're always welcome to reach out. You can find me on the web at elevationfinancial.com. And you can email me there through my website, send me a note on social media, or if you'd like to consider becoming a client, you're always welcome to book a free consultation on my website. You can pick a time online and we'll chat. All right. Thanks, everyone, for joining me today. Have a great day. We'll see you next time.